All right, guys. Welcome to this course. As I said earlier, I said we have about four modules in this course, and I'm very happy for you to be able to purchase this course and for you to be able to make it to this level without wasting much of our time. Without wasting much of our time, um, I would like to introduce you to the topics we're gonna be treating in the module one of this course. All right. So one of the topics we're gonna be treating is introduction to forex, the meaning of forex in detail, benefit of forex trading, common forex trading terminologies that we ought to know as traders. You understand? Common forex trading terminologies that are very popular that you need to know. You understand? As trader. So as a trader, so number five topic is what the six different types of traders that we have, like the one you feel like being. Some people are scalping trader. Some people are position trader. Actually, you're gonna learn about that later. So let's start with the introduction to forex, guys. Okay, what brought about the emergency of forex and why is it that people trade forex and stuff like that? So now, actually, guys, so when we're talking about forex, some people forex is not Ponzi scheme. Forex is not a quick get rich scheme place that you are going to get rich very quick. You understand? You can get rich quick with forex, but not like Ponzi scheme, like doubling your money overnight. You can't be a professional trader overnight. So let's start with Forex, introduction to Forex. So, welcome to the world of Forex trading. Forex is the largest financial securities market in the world. Forex traders exchange over $5 trillion each day. But is Forex the best market for you? That is the question of ours. All right. The answer depends on what you are looking for. If you want a market that never sleeps, if you want a market that will give you more opportunity to trade anytime, any day, and make fucking money, fucking dollars within hours or within months, you understand, or within a year, you understand. If you like to make a bold lot of money in short period of time, forex may be for you. You understand. It should be noted that you may also lose incredible amount of money in a short period of time simply because maybe you did not have proper knowledge. And I'm very sure that for you to be able to purchase this course, subscribe to this great platform. Um, Believe me or not, you are going to make it out lively as a successful trader. Traders with very little money can begin forex for trading forex as well. In forex, you may take relatively large trade with small amount of money because of the favorable leverage requirement. There are many reasons to become a forex trader, but before jumping into the reasons, perhaps let's just take a look, a closer examination at the characteristics and meaning of a forex trading. You understand? Okay, now what is forage itself? Well, I've been shouting and mentioning the term forage since, but I've never really talked about the meaning or the definite definition of what of forage. Forage is simply an abbreviation for foreign exchange market. All foreign exchange transactions involve two currencies. If an individual, a bank, or a government, or a corporation, or a tourist in a Nigerian print shirt on a tropical island decide to exchange one currency for another, a forex trade take place, you understand, in that instance. In every instance, one currency is being bought and simultaneously another currency is being sold in that instance. Currencies must be compared to something else in order to establish value, you understand. So, one currency must be weak and the other currency must be strong. If the currency is weak, if the initial currency is weak, you sell it to buy the one that is strong, you understand. This is why forex trading involves two currencies. If you go and I go to the beach and I tell you the tide is low right now, how do you know this is true? You may decide to compare the current water level to the pair. This is just like how forex usually works. You understand? You must have two currencies, like the base currency and the code currency. When you get there, you're going to know better. If there are starfish and mussel exposed and on tapir, you may believe me because you can compare the current water level to the previous water level. In forex, we compare currencies in much the same way. You understand? Currencies are traded in pairs. You will never trade a single currency. You will always trade in both in pairs. Thus, one currency is always compared to another simply because one currency will always be much more stronger than the other, and the later the later might be weak and the initial one might be strong. You understand? An example may be helpful to illustrate how currencies are traded. If you are a professional trader and you believe that Euro USD, based on your analysis on your fundamental report, is going to go up, you may decide to buy Euro USD simply because you've gotten the report that maybe the consumer index of euro, maybe the European Union meeting is going to affect the rate at which euro is going to move to the upside and the volatility rate. So now you are buying the euro USD currency pair. Another way to look at this is to say you are buying euros and simultaneously you are selling US dollar. For example, now we having something like Euro USD year, all right? So if this Euro USD year simply implies that you are buying Euro USD by selling what USD dollar, you understand? So this unique and often difficult to understand aspect of forex trading to keep in mind in this. Each forex transaction involves always the buying of one currency and simultaneously selling of another currency. Please try as much as possible to digest this. Okay, now I haven't talked about the definite meaning of what of forex and some of the characteristic of forex that we trade currency pairs by simultaneously buying one currency in exchange for another that we're selling. You understand? What are the benefits of forex trading? What are the major benefits of forex trading? Actually, if you should go to Google, you're going to see a lot of stuff or a lot of data that will be talking about the benefit of trading forex. But the major aspect of it is that forex is a 24-hour market for 5 days from Monday from Sunday evening around that 10:30 or 11:30, the market will be open. So trading is pretty much continuous as long as there is market open somewhere in the world. You understand? There is high liquidity in forex that you can actually make a lot of money from it. Trade um you can trade forex. Sorry, I'm coming. Okay, now let's continue. You can trade forex anywhere at your convenient time. Another benefit of forex trading is that there is profit potential from rising and falling prices. Whenever a price is going up, whenever the price of a particular currency pair is going up, you have the as a professional trader, you can trade it and make a lot of profit. Whenever it is coming down, you have a potential way of what trading it and make profit from it also. That is the downside and the upside of the market. You can always make money from it. You can always make profit from it. That is one of the best or the major benefit of forex trading. And the last but not the least is that a better way to financial freedom. Forex trading usually create a better way to financial freedom as you're going to make tons of a lot of money, you understand, from trading it. Hope you're getting that. So now let's talk about common forex trading terminologies that we have. Actually, we have a lot of like millions of forex trading terminologies out there. But talking about the major ones, I'll be dealing with about 14 major common forex trading terminologies here. All right. And as time goes on, as you keep on learning from us, from this course, you're going to learn a lot. You understand? You're going to learn about a lot about some forest terminologies that I might not be able to mention here, because we are time conscious and we need to deliver the best to you. You understand? So now let's talk about long or short. You understand? Long or short. Simply put, to go long and short refers to your trade direction in the market. All right. To go long or short refers to your trade direction in the market. If a trader says something like, "What's up, mind blower? I'm long on Euro USD." This simply means that the trader will make a profit if the price goes up. That is, it is buying the currency. He or she is buying the currency. It means the trader is bullish. Understand? It means the trader is bullish. Is going and he's a bull. Understand? Such person is a bull. He want the market to go up so he can make a profit. And if someone says, "Hey Emmanuel, what's up? How you doing? I'm short on GBP USD." GBP USD is a currency pair. Don't forget in the last lesson. This means that he want the market to go down simply because he believes that based on his analysis or his fundamental report that the BBS is going to go down and is going to make the market by trading the low side. This is the meaning of going long and short in the market. You understand? In a nutshell, going long means you are going bullish. Going short simply means you are going bearish, and that simply means buying and what and selling. Going long simply means you're buying, going short simply means you're selling in the market. Note, you will make money if the market goes down for short, and you will also make money in the long run if the market goes up, if you are long, if you are going long. So either way, you will always make money from the market. That's one of the benefit of forex trading that I actually mentioned earlier. So the next common term of forex trading is what is currency. What do you understand by currency? The word currencies are traded on the forex market. But let's start with the very basics. What is a currency? Some sources refer to currency as a system of what of money, as a system of what of money used among people in a nation. The United Nations currently recognize 180 currencies that are used in 195 countries across the world. Some examples of currencies that are the US dollar, the euro, the British pound, and the Japanese yen, which all act as a store of value and which are traded on the global foreign exchange market forex. Just like other assets, the forces of supply and demand determine the value of a currency relative to another currency. Increased supply of a currency sinks its value. You understand? Hope you are getting it right. While increased demand pushes it of the value. You understand? So what I'm trying to say here is that just like other assets, you understand, the forces of supply and demand we always determine the value of a currency. When people are buying a currency more, the value of that currency will keep on increasing and increasing and increasing over time. When people are selling a particular currency more, the more they sell it, the more it will keep on decreasing and decreasing over time. I hope you're getting it right. So now, the next terminology is what currency pair. What do you understand by currency pair? Even though currencies are traded, sorry, I'm coming. Even though currencies are traded on the forex market, we are not able to buy or sell single currencies. Each time we place a trade in the market, we have to trade on currency pairs. Like we have to trade two currencies, but we will be selling one to buy one or buying one to sell one. You understand? That is the correlation there. An example of a currency pair is the what Euro USD. Euro USD, that is European asset, and what USD dollar asset. When we buy Euro USD pair, we are actually buying the Euro and selling the US dollar simultaneously. That is what that simply means. Similarly, when we sell Euro USD pair, we are actually selling the Euro and buying the USD dollar. You understand? That is what that simply means, simultaneously speaking. Major pairs. Okay, let's talk about major pairs. In general, currency pairs can be grouped into major pairs, cross pairs, exotic pairs. Major pairs are currency pairs that include the US dollar as either the base currency or counter currency. And one of other seven major currency pairs are what? Euro, Canadian dollar, GBP pounds, Swiss francs, CHF, JPY, Japanese yen, Australian dollar, New Zealand dollar. As you are just beginning with trading, you should focus on the major pairs since they usually offer very low transaction costs that is spread and offer liquidity to avoid high slippage. Example of major pairs are what Euro USD, GBP USD, USD CHF. All these are what are major pairs. Now let's move on to the cross pairs and exotic pairs. Cross pairs, on the other hand, include any two major currencies except the US dollar. Unlike major pairs, cross pairs have high transaction costs and at times of lower liquidity, traders can face slippage. Cross pairs are also usually more volatile than major pairs. Example of cross pairs include Euro GPB. Instead of them to have what USD as their counter currency, they'll be having what GPB as their counter currency. That's what we call cross pairs. Euro CHF, you can see that AUD instead of AUD. Finally, exotic pairs include exotic currencies which are not in the top 10 of the most traded currency, such as Mexican peso, Turkish lira, Czech koruna. Since those currencies can be extremely volatile, they should be left to be traded by the pros or professionals. Understand? Now, coming down to exchange rate, what do you understand by exchange rate? Exchange rate of a currency pair is what all traders follow. The exchange rate is often simply called the price, since it shows the price of the base currency expressed in terms of the counter currency. I want you guys to know this. Counter currency is otherwise known as what? Counter currency is otherwise known as what? Quote currency. You understand? So now, for example, now looking at Euro USD, Euro is what is the base currency, counter currency is, or the quote currency is the USD currency, USD dollar. Euro is the what is the base currency, and the base currency is otherwise known as what transactional currency, and some people call this traditional currency. If you make your research very well, you're going to see that. This means that 1 euro cost was, let's say, if the exchange rate of euro USD is what 1.15. This simply means that to get 1 euro, you'll be needing what $1.15 to have what 1 euro, or it takes $1.15 to buy 1 euro. That is what we call what exchange rate. A rise in the exchange rate of a currency pair shows that the base currency is appreciating or improving dramatically. People are buying but more of what euro against what USD, and selling USD against the counter currency, or that counter currency is depreciating against the base currency. Similarly, a fall in the exchange rate shows that base currency is depreciating against the counter currency, or that counter currency is appreciating against the what a base currency. So now the next thing is about bid and ask price. At any given moment, each currency pair has two exchange rate or prices: the bid price and the ask price. The ask price, traditionally speaking, unconventionally speaking, is always much more what high in value than what the bid price. What is the difference between those two? The bid price is the price at which buyers are willing to buy, and why the ask price is the price at which the sellers are willing to sell for the buyers. Given its nature, the bid price is always lower than the ask price. And the difference between the ask price and the bid price is going to give us what is called what spread. The charges that is being allotted to what transaction and process of trading that you perform through the brokerages. So now, either when given its nature, the bid price is always lower than the ask price. Once those two prices meet, either when sellers lower their ask price to meet a buyer bid price, when buyers increase their rate, they are willing to pay for a currency and meet a seller ask price, a transaction occurs. In the end, the buyers buy at ask price. You understand? That is what. Let's say you are the buyer, as you are watching, you are the buyer, and I'm the seller. I have the ask price with me. I have the ask price with me, and I'll be selling the particular currency, maybe USD dollar to you, and you want to buy euro USD. So to exchange it, you have to exchange it in form of what ask price and what and bid price. This means that each price plotted on your chart represents the market equilibrium at that point of time. The price at which the majority of market participants are willing to transact. That's what we call what ask price and what and bid price. People usually buy at what ask price. Traders usually buy at what ask price, and sellers the bears usually sell at the bid price, and the bulls, who are the buyers, usually buy at the ask price. That's just the conventional meaning of what bid price and ask price. And don't forget that the difference between what ask price and bid price is what we call what the spread. So now let's talk about spread. Each time you enter into a trade, you have the paid transaction cost for that trade. Why most brokers don't charge commission and fees on placing trade nowadays? The bid price and ask price spread simply means that the cost to forex traders. When bulls buy at ask price, you understand? When bulls, sorry, I'm coming, guys. When the bulls buy at ask price, the price at which sellers are willing to sell their asset, their position is immediately in a loss that equals the bid price and ask price straight. If you are a day trader or scalper, you need to pay attention to the bid price and ask price, since it can eat a larger portion of your profit at the end of the day. Swing traders and position traders who have a longer term approach are less affected by this strategy, by this strategy of the spread, as they open a smaller number of position and have relatively higher profit targets. You understand? So now, talking about PEEP, what do you understand by PEEP? Some people call it percentage in points. Some people call it percentage in value. You understand? We have different stuff, but the recognized meaning of what PEEP is what percentage in points. When forex traders talk about profit or losses, they usually make use of what of PEEPs. If you are to withdraw money from the market, from the brokerage, you usually make use of, you usually do that in terms of PEEPs. We don't call it what I make $2,000 profit. No, I make 2,000 pips profit. You understand? That's how pros call it. You understand? Usually one pip usually equals to the fourth decimal of most currency pairs. For example, if Euro USD is currently trading at 1.1558 and rises to 1.1562, that rise will equal to a change of what of 4 pips. Because if you should add what 4 pips to what 1.555, you're going to have 1.55, 1.562. You understand? That's an increase by what 4 pips. So that is the reason why I said 1 pip equals to the 1 pip equals to the fourth decimal of what of most currency pairs. However, Some currency pairs have their pips located at the second decimal places. Majorly currency pairs like Japanese yen. You understand? Japanese yen has it. Like Euro JPY, USD JPY. Currently, they usually trade at what 1110.25. You can see that that's what second decimal place. So I'm forced to let us say if USD JPY currently trades at 110.110.25 and falls to 1110.110, that will fall equals to what 15 pips drop. That's about 15 pips drop. Let's say you go short, you are making $15 in that instance. So now let's now talk about, actually you are still going to learn much more about that in the next section. Let's talk about support. What do you understand by support in forex trading? Support and resistance are one of the most important concepts in technical analysis. If you are a technical analyst trader, technical traders analyze only price move as they believe that the price reflects all available information, and support and resistance trading an important role in the analysis. The market are made of crowd of people that speculate, hedge, trade, invest, or gamble in the market. Since people have memory, they remember certain price level where the price are difficult to break down. So they usually make use of that to project whether the market is going to go down, market price is going to go down or come up. I hope you are getting that. So now they place their buy order around those level at the support level. And another name for support level is demand level. You understand? When the price is very low, people usually buy, and when the price is very, very high at the resistance level, people usually sell. So now let's talk about what resistance. Just like support levels or support zone, resistance level or zone are also a crucial tool in technical traders' toolbox. While support levels are based on previous lows, resistance levels are based on previous highs. You understand? Highs of the market at which price are difficult to break above and go up more furtherly. Traders remember those levels and place their sell order around them. You understand? Whenever the price is high, don't forget that based on the basic law of demand, the basic law of demand states that whenever the price is low, buyers usually buy more at low prices. Whenever the price is high, buyers usually buy less. You understand? But whenever the price is usually the price is at higher peak, you understand? High peak, the sellers usually sell more, and whenever the price is at the low peak, low or trough, the sellers usually what they don't sell. They would rather just wait for best opportunities to sell at higher prices. So traders remember those levels and and they usually place their sell orders around them, as they believe that those levels will again provide selling pressure and move the price down. Since fresh memory is more important than old memory, recent support and resistance level are usually have a higher importance than old support and resistance level. Actually, you're going to learn about this in the pragmatic approach to the resistance and support trading analysis. So now let's talk about leverage. The forex market is open around the clock and offers traders to profit not only on rising prices but also on falling one. However, there is another reason why a large number of traders feel under attracted to forex market leverage. Trading on leverage allows traders to open a much larger position size than initial trading account size would otherwise allow, and the forex market is known extremely high leverage ratio offered by retail brokers. For example, 1 to 100 leverage allows a trader to open a position that is 100 times larger than initial deposit. For example, now if you deposit $1,000 in your brokerage trading account, you are allowed to open a position size of what $100,000. However, bear in mind that it is extremely on high leverage is very, very risky, as it can chop off your money at a glance, as it boosts not only your profit but also increase your loss as well if you are not taking your trade very well with the best strategy. Beginners should always consider trading on lower leverage until they gain enough experience and screen time. From then, you can then what start taking what high proper risk management and stuff like that. So now let's talk about margin. What do you understand by margin? When trading on leverage, your broker will allocate a portion of your trading account size as the collateral for leverage trade. This collateral is called margin. Its size depends on the leverage ratio that you are trading on. A leverage ratio of about 1 to 100 asks for a margin that equals to 1% of your position. That is what you should be risking 1% of your position. Always consider your margin whenever you are trading. For example, if you open $100 position size using 0.1 using 1 to 100 leverage, your margin will equal to $1,000, which is 1% of the position size. Similarly, if you open a position of what $40 with a leverage ratio of what 1 to 100 risk reward ratio account size of what $1, your broker will allocate a margin size of what $400 to you. Even $50 we allocate what the brokerage size we allocate margin size of what $500 to you. $60 we allocate $600. That's how it is. You understand? Vice versa. What is important when trading on leverage is to always keep an eye on your free margin. Your free margin must always be equal to your total equity account size plus any unrealized profits or losses minus your use margin minus your use margin from it. If your free margin drops to zero, you will receive a margin call and all your open trades will be closed at the current market rate, whether losses or profit. Loss size. Now what do you understand by loss size, which is the last terminology that I'll be explaining here? The position size you take on the market determines the size of your profit and losses in dollar value by affecting the value of a single peep, like a single drop of the market, a single drop or increase in the market. In the forex market, one standard loss size, standard position equals to what 100 units of the base currency. For example, if you take one standard lot, like 1.0 lot on what Euro USD pair, you are actually taking what $100, 100,000 euros with a p value of what $10 each move. Fortunately, traders with smaller account usually can take smaller trade with what main lots um like what 0.1 lot size. Some brokers even allow you to trade on nano lots, you understand, 100 unit of the base currency. In any case, calculate your lot size independence of the size of your stop loss so that you can so that you remain inside your risk management boundaries and never be push off push off the market, you understand, on losses. Along the run of learning this course, you guys are going to learn more about forest terminology in the long run because you are going to be familiar with some stuff in the long run. So let's move on to the next topic. So now, what are the types of traders that we have? Forex traders tend to fit into one of the following six type of trading people that I fought that I shoved out. You understand? We have what scalper trader, we have day trader, we have swing trader, we have position trader, we have algorithmic trader, we have event driven trader. Reading about the separate types of below and discover the character trait that they optimal for each. We help you to determine whether this is what you fit in when you are done with this course, or this is not what you fit in. Yes, and you'll be able to determine the best types of what trading system that is going to fit you as a person or as a trader. Scalper. Scalpers are short-term traders focusing on holding position for time frame as small as few seconds to a few minutes. They usually trade in minutes. Forex scalping trade strategies involve trading frequently throughout the day with the intention of achieving small gains at busiest, most liquid. At times, scalper live live in the fast lane. They usually trade in minutes, continuously faced with processed new information and reacting to rapid market changes. You will ideally be observant. You must be ideally be observant, instinctive, intellectual about your trading system, witted, but always under pressure of winning or losing as a scalper trader. It is very very risky. I don't usually advise someone being a scalper trader, but if you know that you are fitting, you can actually take it being a scalper trader. Day trader also executes frequent trade on an intraday time frame. While their routine will not be as fast paced as scalpers, day traders will similarly close up position before the end of the day trading so as not to hold or any overnight. This means the trades are not affected by negative news that are in price before the market opens or after it closes. To be successful as a day trader, you will need to be ready to adapt to quick changes in market as well as be cognizant of techniques important to this style of trading, such as trading the gap in the style and trading based on what your own strategy and apply your own day strategy and day journal. So now the third type of trader that we have is swing trading. Swing trader, you understand? Swing traders hold on to are people that usually hold on to trade for longer than a single day. They usually hold trade for like days, you understand, couple of weeks over this short time frame. Swing trader usually will typically favor technical analysis over fundamental because they don't usually value fundamentals except fundamentals like NFP, economic and some other economic news like that. Although they should be attuned to the news event that can trigger volatility, you understand, like NFP. This day trader is less frantic than scalpers, and day trader so extreme alertness is less of a frequent because you will always still require a strong eye for detail when it comes to chart analysis and pattern determination in order to determine the next price movement in the market. You will learn in detail how to do string trading in your next classes. I hope you are getting that. So now the next type of trader that we have is what position trader. Position traders all trade for longer period of time. These kind of traders can only be found in what big institutions, financial institutions like banks, central bank of different countries, microfinance banks, commercial banks, and all these banks, financial institutions, they usually engage in what position trading system. Understand? Position traders are less interested in an asset short-term price fluctuation and more concerned naturally with the performance over more sustained time frame. As a forex position trader, you will require patience as your money will often be locked up for long time period, particularly with long-term trade. A thorough knowledge of fundamental factors is beneficial. So advanced analytical skills will serve you well. And you are going to get that here by learning about technical analysis because we trade price action, not indicators. So now, the next type of a trader that we have is what algorithmic trader. Algorithmic traders relies mostly on what computer programs like programming software to place trade for them on their behalf at best possible prices. Traders can this kind of trader usually make use of a divine strong instruction or high frequency trading algorithm or programming system to either code the programs themselves or purchase existing one from different platforms that know about how to program trading system. These types of trading suits people who are comfortable with using technology and want to apply it in their forex career. Given the nature of the programs, algorithmic traders will always have a keen eye for the technical chart. Event driven trader. Who are the event driven trader? Who are they? What do they do? Understand? Event driven trader look to the fundamental analysis. Usually, there are people that fall in love with what non-farm payroll, NFP, GDP, gross domestic product, NFP, employment figures, consumer price index, and election. How all these economic news and economic factors usually affect the price movement in the market. For example, now non-farm payroll as a case of study as one of the major news that usually affect the forex markets volatility rate. Usually comes up every first Friday of the month. For example, now the first Friday of this month, May, is going to come up. You understand? And whenever it comes up, trader usually await what the for the actual value to be much more greater than the forecast value. Once the actual value of the data economic data report of NFE is greater than what the forecast value, the any USD pair, any USD pair we have what high volatility rate in favor by buying, not selling. So this type of trading will suit a person who likes to keep up with the world news and who we understand the events can who we understand how events can actually impact the forex market. Inquisitive, the person must be inquisitive, curious, intellectual, and forward thinking. You'll be able to skill at processing new information and economic news and predicting based on all these news and factors how global and localized event may play out in your forex trading journey. So all these six types of traders that I just mentioned now are the major types of trader that we have. We have discretionary traders as well. All these people in decision that usually make use of what technical analysis and stuff like that to trade. So, but the major types of forex trader that we have is what is a scalper trader, swing trader, algorithmic trader, event driven trader, um, position trader, and what um, day trader. You understand? All these people are what are the major types of forex trader that we have. So this is the end of what of module one and all the topic under it. Module one and all the topics under it. So now thank you very much guys for watching. We'll be moving on to the next lesson, and I'm very happy for you guys because you are going to be learning about new stuff now. You're going to be exposed to new stuff now. So please and please try as much as possible to be jotting as you are learning and make sure you are putting into practice and stay devoted, stay committed, and never give up on learning. All right.